Welcome to this explainer. Listen, today is all about turning you from an everyday intermediate trader into a highly disciplined structural risk manager. We're going to break down the COT event-driven trading framework, and we're going to map out exactly how you can use commitments of traders' data to anticipate, prepare for, and ultimately profit from those crazy, high-impact economic releases. If you are totally exhausted from acting like an emotional news reactor and you're ready to trade like a professional with a genuine structural edge, well, you are in the exact right place. But first, let's just be real for a second and start with a tough love question that every single trader has to face at some point. Why do high-impact news days destroy so many trading accounts? We've all seen it, right? Those disastrous blown account screenshots floating around on FOMC or CPI days. The market suddenly whipsaws, stops are aggressively hunted, and traders lose literally weeks of progress in just 5 minutes. So why does it happen? It's simply because most traders out there are flying entirely blind. They're just reacting to flashing headlines instead of looking at the underlying market structure. Okay, let's dive into this. The solution here is what we call the dual force model. You see, the market is moved by two distinct forces. Force one is structural positioning. That's the slow, steady accumulation of positions by the major players, which gets revealed in the COT report. Force two? Those are your catalysts, the scheduled events on the economic calendar. And here is the absolutely crucial secret. The structural positioning dictates the magnitude of a price move, while the economic calendar dictates the exact timing. Think of it using this brilliantly simple fire analogy. The COT report essentially tells you just how dry the forest is. If we're seeing a COT extreme, that forest is tinder dry. Then the economic calendar tells you exactly when the lightning storms are scheduled to hit. You put a bone-dry forest together with a scheduled lightning storm, and what do you get? A massive powder keg. You absolutely need to know when those sparks are scheduled to fly so you aren't caught just standing right in the middle of a massive blaze. Now, a huge part of identifying that powder keg is knowing exactly where the retail crowd is hiding, and we find them by looking closely at the non-reportable net long metric. This specific data point is exactly how we pinpoint retail traders in the COT report. When this particular group is heavily positioned on the exact same side as managed money hedge funds, the crowd is officially all in, and that creates an extreme, glaring vulnerability in the market that's just waiting to be violently unwound by a sudden news event. Section 1. Preparing for battle, scoring your event risk. Think of me as your guide through these high-impact days because I want to make sure you have a quantifiable, solid plan before a single piece of data ever hits the wires. First things first, we must categorize our lightning storms. Not all news is created equal. Tier 1 events, your FOMC decisions, non-farm payrolls, and CPI, those are your biggest, most dangerous lightning storms for assets like gold. Tier 2 and Tier 3 events are certainly important, but they very rarely trigger massive, immediate COT-driven liquidation cascades on their own. So you want to focus your heavy preparation squarely on Tier 1. To properly prepare, you're going to calculate an event risk score, or ERS, right before those major releases. It's a very simple 3-step formula. First, calculate the COT vulnerability based on positioning extremes. Next, weight the event tier, so give a 100 score for FOMC and something much lower for minor data. Finally, factor in the surprise potential, based on historical volatility. By blending these three things together, you create a strictly quantifiable 0 to 100 vulnerability score well before the market goes absolutely crazy. And once you have your ERSs, you consult this table to mandate your position sizing. Let me be super clear. This is non-negotiable structural risk management. If your event risk score screams 75 to 100, meaning extreme risk, you must aggressively cut your position size by 75 to 100%. Do not add new positions, no way. When the structural vulnerability is sky high and a Tier 1 event is looming, you protect your capital by drastically sizing down. Section 2. The heat of the moment. Event day trading strategies. All right, so your risk is managed and your positions are sized perfectly. Now, when the news actually drops, there are two primary execution strategies we use. Strategy 1 is fade the spike, and strategy 2 is momentum continuation. The absolutely crucial deciding factor between these two is whether the economic data contradicts or confirms the COT extreme. If the news contradicts the extreme structural positioning, you fade the algorithmic spike. If the news validates and confirms that structural positioning, you trade right along with the momentum. Let's walk through a step-by-step hypothetical using strategy 1, fading a CPI release. Imagine the COT positioning is heavily bearish. But then, the CPI report comes in unexpectedly cool, which is traditionally bullish for gold. Instantly, algorithmic trading spikes gold prices up. The move is going entirely against the heavy structural bearish pressure. Your job? Don't panic. Wait for that first 5-minute candle to fully close. Once it clearly shows a reversal, you enter short, placing your stops safely beyond that initial emotional spike high. Now, what's really interesting about this slide is how we handle the exact opposite scenario. Enter strategy 2, momentum continuation. This time, CPI comes in hot, a hawkish outcome that perfectly confirms our bearish COT positioning. Gold immediately drops. The catalyst and the structure are completely aligned. Once again, you wait for that first 5-minute candle to close. But here, you enter short on a slight pullback to the moving average, setting your target to ride that massive wave of structural liquidation. Now, if fading or momentum trading just isn't fitting the setup, we have 2 alternatives in our back pocket. Strategy 3 is the options-based straddle hedge. This is perfect for those extreme COT setups right before massive Tier 1 events where you expect insane volatility, but you aren't exactly certain of the direction. And strategy 4? Well, that's the wait-and-see approach, because honestly, sometimes the absolute best trade you can make is no trade at all. In fact, I want to deliver a little bit of tough love right here. If the COT is neutral, close the platform. Go for a walk. I literally cannot emphasize this enough. If you calculate your pre-event numbers and the COT lacks a clear directional edge, the market is quite literally just flipping a coin. Do not gamble your hard-earned capital on random noise. Strictly enforce the stand-aside rule. Section 3, Post-Event Analysis, Separating Structure from Noise. Okay, once the dust finally settles and the initial frenzy of the trading day is over, the real analytical work begins. To distinguish a genuine regime change from just a temporary blip in the market, we look at specific metrics published on the following Friday. These are the exact indicators of a true structural reversal. Has the COT index dropped by more than 20 points? Has open interest significantly declined, showing us closed positions rather than new trades? Is managed money actively liquidating their net long positions? If these boxes are checked, my friend, the event triggered a fundamental shift. And this brilliantly illustrates that a structural unwind doesn't just happen in a single day, it follows a very specific post-event COT reset pattern. Week 1 is all about the initial impact and heavy liquidation. Week 2 sees that follow-through momentum. By week 3, the market finally begins to stabilize and catch its breath. And by week 4, new accumulation begins. Truly understanding this timeline prevents you from getting chopped up trying to counter-trend trade way too early. Section 4, the psychology of event trading. Finally, let's address the massive elephant in the room. You can have the best data in the world, the perfect event risk score, and a totally flawless execution plan. But listen to me, none of it matters without the right mindset. On news days, retail traders fall into the exact same psychological traps over and over again. They over-leverage because an outcome feels like a quote-unquote sure thing. They blindly trade the news headline instead of trusting the structural COT data. And worst of all, they react purely on raw emotion because they never even bothered to build a pre-event plan. These are the exact pitfalls that turn intermediate traders into fresh liquidity for the professionals. So how do we actually conquer these traps? Well, you maintain absolute discipline by forcing yourself into concrete rules. Pre-commit to your ERS sizing adjustments. If the math says cut your size by 50%, you cut it by 50%. No exceptions, no second guessing. And physically write down your post-event plan before the release even happens. Literally write, if CPI is hot, I do X. If CPI is cold, I do Y. That is how you keep your head totally clear when the market noise becomes absolutely deafening. We've covered a ton of ground today. Everything from scoring vulnerability to fading the spike to really mastering your own psychology. The economic calendar is no longer something to be terrified of. It's a map of opportunity overlaid right on top of the structural terrain of the COT report. The calendar is your co-pilot now. But my final question to you is, are you ready to navigate the lightning storm? Keep this explainer close during the next high-impact week. Fully trust the framework, and I'll see you next time.